Hello and welcome to Market Domination. I'm Jared Blikre, in for Josh Lipton, live from our New York headquarters. We're about 30 minutes until the closing bell, the final one of 2025. Let's get a quick check on the markets. And we got another down day here. I don't know what's going on this week, but the Dow is down about 55 basis points or 265 index points. And you can see we have spent the entire day in the red and we are at the session lows right now. Here's the NASDAQ composite down about 0.2%, very similar chart. And the S&P 500 very similar as well. I'm going to show you the 5-day view because that's how many days we are into the Santa Claus rally, but it is looking like the Santa Claus slump right now. The good news, we got 2 more trading days in the Santa Claus rally into the close on Monday, so watch out for that. But right now, we're looking at a little bit of a loss there. And we got to check in on the bond market, 30-year T-bond yield. How did we close out the year? 4.84%. That was up 3 basis points from the day before. The 10-year up 3 basis points as well to 4.16%. And just checking in on volatility real quickly, this is also over 5 days. Pretty choppy here, but still under that 15 mark. So not a lot of turbulence in the market that we've had to worry about over the last few days, despite that little slump. And look at that. This is a sector action. Everything in the red here. In 30 minutes, we're going to do the closing bell, and S4A is going to walk us through the year-to-date totals, but let's take a look at what December has brought us. Financials up 3%, followed by communication services, materials, industrials, consumer discretionary, tech, all of those outperforming the S&P 500, and also all of those in the green. Everything else in the red here to the downside, utilities and real estate, staples, healthcare, energy, all those defensive sectors have taken a backseat, and that's actually kind of a bullish setup there that we have those defensive sectors in the red here. And here's the NASDAQ 100. Might as well show you the monthly totals first. You see a lot of red. Broadcom down 13%. Tesla up 5% though. So is Nvidia. Meta up 2%. Then you see a little bit of a loss there for Microsoft, Amazon, Alphabet, and also Apple. But let's check in on what's happening today. And you can see a very red board there. This is not the story of the year. Again, we're going to get that in 30 minutes, but only a few spots of green. It looks like Netflix and a couple others, EA, some really tiny boxes here. And I'm going to move over to the Dow and see what we got going on there. Very similar story, a little bit of upside in Nike. That's up 4.6%. Not a lot more green that we're looking at here. So kind of an inauspicious end to the year, but stocks are on track for their 4th straight losing session, dimming hopes of that Santa Claus rally. Still, this has not dampened bullish optimism for the markets in the new year. In fact, our next guest says he expects the bull rally to continue with momentum to the upside. Joining me now is Alonzo Munoz, Hamilton Capital Partners Chief Investment Officer. And thank you for joining us here, Alonzo. Let's talk about predictions for 2026. We had a lot of surprises in 25, but broadly speaking, what are you expecting for the new year?
Jared, good to be here. Happy New Year. And hopefully it does turn into a Santa rally over the next couple of days versus a Santa slump. But look, we're optimistic as we go into next year. We've been talking to our clients about what to do, where to allocate new capital. And we think that technology continues to outperform going into next year. The setup is ripe. The GDP is strong. The economy's humming. The Fed is lowering rates. So we think that this rally continues going into 2026.
Very good. And let's talk about some specifics there. We've had concerns about concentration. There's too much money or too much performance by the big tech. But to end the year, we didn't really see that. We actually saw things kind of broaden out. You take a look at the equal weighted indices. We saw a lot of participation. So where do you think the big moves are going to happen next year?
Well, Jared, I think that's a little, just to back up, I think that's a little bit of a good thing to see some money flowing out of some of those high valuations, maybe spreading the good luck across the market. But going into next year, the setup is so good for some of these AI and tech companies that are delivering on earnings. We have a lower rate environment, the economy's humming really well, and the leaders are continuing to lead. So Jared, you know we own Google, you know we own Tesla, you know we own some of these big tech companies, and we have for a long time. These bouts of volatility are not going to change the narrative. We're just going to be by the dippers.
All right, buy the dippers. I like that. It worked out pretty well in 2025. Even when you had that post-Liberation Day slump that was almost a bear market, Let's talk about the Fed, because that has been a big wild card. And I note here that you're saying that there might be a rate cut in January. That is against consensus. So talk to me about what you expect from the Fed this year.
It is. So we saw the unemployment rate rise a little bit to 4.6. And I think that's going to be important as we really, analyze inflation going into the next couple of months. Inflation data came in a little bit better than expected, and that unemployment rate is rising. And so that really backs the Fed into a corner on what to do. But think about some of the risk here. Jerome Powell is on the way out. The President Trump hasn't made a decision on who's going to be the next chair of the Fed, and we think that consensus is shifting. FOMC minutes came out yesterday. A lot of movement toward maybe rate cuts in 2026, maybe even January. Interesting.
And lower rates, they tend to help some of the startups. And so I'm just trying to pivot here to IPOs, because we got some big ones on deck here. OpenAI, Anthropic, maybe SpaceX. So what do you expect there?
So Jared, SpaceX, potentially $1.5 trillion IPO. I mean, that would be absolutely...
It's going to take up a lot of space on that heat map over there.
There is no doubt about that, and that breeds that enthusiasm. That we don't think that SpaceX would go public if the momentum in the market shifts to the downside. So we think all of these things, these IPOs, are going to be bullish for the market. And we had a great year in M&A. We had bank M&A, we had tech M&A, we had basically M&A every year. The market had been frozen for about 2 years, so we think it's a really bullish signal.
And one of the big themes coming into last year, 2025, was the regulatory environment. Lots of expectations, and there were a lot of changes in the regulatory environment by President Trump, and some of those aren't taking effect until this year. Just what do you expect there?
Well, I mean, regulation can, slow companies down. And so as we look to next year, we wouldn't have all of these mega IPOs if they were going to be scared of regulation. We're looking overseas, too, at Europe. We're looking at Asia and how they regulate some of our large tech companies. And that's been front of mind. It wasn't very long ago since we were talking about Google and their antitrust. I mean, they just recently got out of that hump.
Yes,
and so it's exciting time. And we think that regulation will continue to allow the capital markets to expand.
And we have midterm elections coming up this year. Historically, when we have this year in the presidential cycle, we usually see some hiccups in Q2 and Q3 as things kind of get dicey. Any expectations there based on seasonality, or just your appraisal of what the way things would go specifically in this year?
Well, what we're telling our clients is we have to be nimble, we have to be dynamic going into next year. We have the Supreme Court potentially ruling on tariffs. We have midterms potentially shift in the House, is what we're talking about. And so we could see a lot of volatility. But again, Jared, we're going to be by the dippers. We have a lot of conviction in our technology picks. We have a lot of conviction in the market. And if there's volatility, we're going to take advantage of that. All
right. I will give you the floor here on the last question. Anything we didn't get to that you want to talk about and say to the viewers for 2026?
We're going to have a great year. I mean, what a year. I remember Liberation Day. We had a government shutdown. I mean, they really kept us on our toes. And everything rallied. Gold rallied, copper rallied, silver. I mean, just about everything out there. Bonds. So we're going to be dynamic. It's going to be a fantastic year. There's a lot to be positive. And the U.S. turns 250, so we're excited about that.
Yes, and I turned 50 as well. So that'll be another celebration in October. Thank you. Thank you for stopping by here.
Thank you, Jared.
And with the new year comes a fresh batch of opportunities to set up your portfolio for upside potential. And we're uncovering which names exactly can help make some investing magic. Barbara Doran, BD8 Capital Partners CEO and CIO, joins us now. Thank you for joining us here. And I just want to get... Yes, I want us to show the Wi-Fi Interactive because you have a few picks for the next year, and we're showing the 2025 year-to-date totals, and you can see some big ones there: NVIDIA, Alphabet, Broadcom, Goldman Sachs, Uber, Netflix, Gold, Boeing, Starbucks. What's the theme here, or are there a couple different themes that you like?
I think there's a bunch of different themes. Even among the technology stocks, there's clearly an AI theme. I think NVIDIA and Broadcom, people keep getting spooked about overbuilding, too much capacity. It's a bubble. I don't see it. And NVIDIA right now is at 26 times, earnings next year, and those earnings will come up. And so I think by a lot of accounts, and I certainly believe this, that we are still in the early innings. And if you look at, for instance, the number of corporations that have yet to really integrate AI fully into their operations, we're talking single digits. A lot of people are really working with consultants, trying to understand what they need, how they implement. And so I think you're going to continue to see this happen, and you're going to see ongoing productivity increases. The other names, I mean, you have One is a turnaround. Obviously,
Would that be Starbucks? All right.
Yeah, you got it. You got it. It has not done that well this year because there's always a question of timing in these things. And I think here you had Brian Nichols, the Star CEO, who came in after turning around Taco Bell and Chipotle. It was a big hire because Starbucks had lost its way, a great franchise, premium franchise, but it sort of had lost its step there. So he's putting a lot of initiatives into place, whether it's about operational efficiencies, changing the ambiance, the experience of the customer, the staffing, et cetera. But a lot of those big initiatives are not going to really bear fruit fully until this year. However, in the last quarter, we saw for the first time in almost 2 years, they had positive same-store sales. And to me, that's an indication that the turnaround is working. And at these prices, I think the risk reward is very attractive on Starbucks.
I want to talk to you about another kind of outlier here. We got GLD on your list. That is the gold ETF, and we saw gains in the precious metals. Gold was on the small side. We saw silver 150+%. What do you like about the precious metals in 2026, specifically gold?
Well, I think that for me, there's two categories. One is gold. And I think what gold is going through, gold always was the refuge in terms of if there was fears, geopolitical uncertainty, inflation. But I think what's been happening over the last few years since Russia's foreign reserves got impounded when they invaded Ukraine back in early 22, and that was I think 600 billion. A lot of other smaller central banks are saying, hey, wait a minute, we don't really want to be hostage, to foreign powers. And gold is an easy one to up in the portfolios. I mean, if you look at the percentage of gold we hold, or Germany, or some of the European countries, it's over 70%, in our foreign reserves. But other countries, it can be under 10%. So I think that is what you're seeing is steady central bank buying, and I don't think that stops anytime soon. So I think gold, despite its big run this year, can go higher. Now, the other metals, you're talking silver, copper, aluminum, nickel. These are all things that are so important in data center build-outs. And that, as we know, is just going gangbusters. And there's lots of building to do over the next few years and probably longer. So I think the demand for that, it's almost like the supercharged commodity cycle we saw when China was just beginning to ramp up and really transition from this very rural backward economy to where they are today. So the commodity cycle was not just a typical cyclical, supply demand was critical to watch for a year or two, then it would be over. I think this has legs, and for the reasons we just discussed.
I've heard a lot of talk about a possible super cycle as well. So want to move on. Netflix only up 5% this year, but admit it has found itself in a lot of M&A drama, shall we call it that? Warner Brothers Discovery. What do you think happens with Netflix and with some of those headlines that we've seen on the M&A front?
Yeah, Netflix is down some 30%, but I think there's probably 40% upside because these are, they have won the streaming wars. I think it's been more than M&A. In the last quarter, they disappointed in terms of subscriber growth. Churn was a bit higher than people expected, but I think that's a lot of noise because even as growth can slow, they have so many levers to pull. They just continue to churn out new content, and really new content. I think it's over 60% of what viewers watch. And plus, if they get the library, of whether the HBO. That's 100 years of film and TV and franchises like Lord of the Rings and Harry Potter, and that would be a win-win. But it's hard to measure what that's going to be because they are paying a premium for that. But I think Netflix is still, is down here, especially the risk reward is extremely attractive.
I want to ask you about Boeing. This is a stock, we know it had huge troubles in 2019, 2020 coming into the pandemic. It's gone basically sideways for 5 years, but it's up 20% 2025. What do you like about Boeing? Have things changed? Is it the year of the Boeing comeback?
Well, there's been a lot of false starts. I thought a year ago it was the year of the comeback, and then they kept having delays. But it looks like what we're seeing the last 4, 5, 6 months is that deliveries on some of their key planes are really ramping up. And of course, the stock was moving up nicely. Then we had a drop because a new plane has been delayed, certification, all that sort of thing. But they are actually, I think the key tell here is that they expect to have positive free cash flow next year for the first time in a long, long time. So I think with the ramp up of 2 critical planes, and the third one will be coming on next year, fingers crossed, but they really seem to have up their quality game with new management, et cetera. So again, the risk reward I think is attractive here.
All right, Barbara, we got to leave it there, but it has been a pleasure talking tickers with you. Thank you.
Anytime. Thank you. Happy New Year.
Happy New Year. And coming up, we take a look at some of the biggest CEO changes coming in 2026, up next on Market Domination. 2025 was a year when CEO transitions, succession plans, and even pay packages moved the market, sometimes more than earnings. From high-profile leadership announcements at companies like Intel and Walmart to questions around Tesla CEO Elon Musk's compensation. And now the looming transition at Berkshire Hathaway. Investors are paying much closer attention to who's in charge. For more, we're bringing in Bill George, former Medtronic CEO and Harvard University Executive Education Fellow. So thank you for joining us here. Let's talk about some of these new crops of the new crop of CEOs coming in. The big one, as we were just talking about, Berkshire Hathaway. Warren Buffett is out. We got P&G, Target, Walmart, Lululemon. The list goes on.
Well, I think, first of all, Warren Buffett, there's no one that can replace Warren and what he has done. He is a legend. He's done it for 60 years. But his principles are so basic that I think Greg Abel, as his successor, will carry them on, will not make major changes. And I think Berkshire Hathaway's approach to investing will continue as it is. So I'm optimistic about that. I think some of the biggest changes are going to come on the retail front. You see Walmart, I think Doug McMillon is one of the finest CEOs in the world today, along with Satya Nadella at Microsoft and Jamie Dimon at Citi. And he's stepping down in February, and John Furner's taking over. And if you look at Furner, 30 years, like the ideal grooming. He's been CEO of Sam's Club. He's been chief marketing officer, chief merchandising officer. He runs all the U.S. operations. And Walmart is very well positioned to continue to dominate retail, including the online business. They'll obviously have strong competition from Amazon, but I think you'll see Walmart doing well. The biggest changes I predict are going to come in Target, which has had a disastrous year under Brian Cornell's last year. And I think under Michael Fidelki, he's going to return Target to its roots of competing on design and style and having unique offerings that are different from Walmart, more upscale. Cornell's taken them down a bit, a lower scale, and abandoned a lot of things Target stood for when I was on the board. So I think you'll see Michael doing a terrific job in restoring Target. He, like Furner, knows the business, has been in every aspect of it, and I think he'll do a very good job. So.
And let's talk about some of the broader trends. We've seen, let's talk about AI, for instance. We've seen the huge AI build out so far, and now we need to start talking about AI adoption. That's where the rubber meets the road. Talk about monetization. And we've seen this come in fits and starts and lots of predictions out there. But what do you think? How do you think it plays out in 2026?
Well, you nailed it. It is going to be the year of AI adoption. If you think of 2025 as a year when all the AI companies who are focused strictly on creating AI platforms really are building out tremendous amounts of data centers, a lot of pressure on semiconductors with the NVIDIA chips and others competing along like AMD to compete with them. But I think now the focus is going to shift to companies and how fast are they going to adapt AI. Those that don't get regressively into AI are going to be left behind. So I think they have to adopt rapidly. The problem I have is that many CEOs are strictly thinking about this as efficiency. Yes, it is efficiency, but I think they need to think more about how can they make their businesses more creative? How can they do things that they've never done before using AI? All the great, seven most valuable companies in the world today have new business models. What are the new business models going to be for AI? Not just AI, but what are the business models that each of these industrial or consumer-based companies are going to have that they haven't had before? And I think that's where CEOs need to focus their attention in addition to the efficiency. But go ahead.
Yeah, great questions. Let's switch gears and talk about the Fed briefly. And according to your notes, you're saying that CEOs should ignore the Fed in 2026. I like that, but I'll let you explain it.
I think CEOs have been way too focused on the Fed. What are they going to do next? Look, the Fed is probably going to cut interest rates because they're going to focus more on jobs and inflation. They seem more willing to keep inflation up around 3%. I think companies are going to push through price increases this year from tariff-based things and other opportunities they have. So I think you'll see inflation above 3%. But the job market is hurting, and it's going to get worse, I predict. And it's going to be a white-collar revolution. It's not just going to be blue-collar. It's going to be the white-collar market. I don't see a big surge in manufacturing jobs coming back. They've been down this year. They'll be flat the coming year. But the real changes are going to be in cutting overhead and taking out a lot of costs from white collar workers, all those analysts. And, college graduates are having more problems getting jobs than ever before. Even in Boston, the biotech market, people are having trouble finding jobs. So I think you'll see big changes coming. And so I think the companies really need to focus on upgrading their frontline employees. A lot of them are thinking about eliminating frontline employees. I think they need to make them more effective and transform their whole overhead structure to eliminate a lot of overhead roles, a lot of staff analyst roles that really haven't proven very productive. But give people the tools on the front line and they'll be much better. And you need those first level frontline people. They're the ones in touch with customers.
Yes.
So the companies who are going to excel are the ones that focus on their customers.
I agree with you there, and we have to leave it there, but thank you for all those insights. Really great talking with you.
Hey, thank you for having me on, and Happy New Year.
Happy New Year. And we are going back to basics today for the Options Pit, brought to you by Tasty Trade. I spoke with Sean McLaughlin, All-Star Chart's chief options strategist, who broke down the most fundamental option trades. He's part of that conversation. We have two basic components in options. We got calls and puts, and we got a little grid here. And so you can do two things with either a call or put. You can go long and buy it, or you can go short and sell it. And this creates different rights and obligations here. Maybe you can break it down for us.
Sure. So if you buy a call, that's a bullish move. You are betting on the price of the stock going up. And if you are an owner of a long call, that gives you the right but not the obligation to take ownership of the stock at the price of the strike.
Right here.
Yes, and you pay a premium for that. The premium tends to be, a couple dollars depending on how far away the strike is. But the nice thing about buying a call, or in this case also buying a put, is your risk is defined to what you pay. You cannot risk or you cannot lose any more, which, hey, if you have a stock that has a severe gap against you overnight, maybe due to earnings, you like having that comfort of knowing that
you don't get surprised.
You're not going to be surprised. You can size your position in a way that you know the most you can lose. And that's a really good way to sleep at night.
Now, Sean, what if you don't want to sleep at night? What if you're a fan of unlimited risk? Let's talk about the short side here.
Well, if you like unlimited risk, then selling naked short calls would be the way to go. Selling a naked short call is attractive to certain traders because they like to collect the premium, and their bet is that the option is going to expire out of the money. So let's say...
So another trader is going to pay you for that money. That's called the premium, and then you get to keep that. And then, sorry to interrupt you there.
Yeah, so if the stock closes below the strike price of the option, let's say you sold a 100 strike call and the stock closes at $98 on expiration day, then that premium that you collected when you sold that call is yours to keep. You don't owe it to anybody, it's yours. And it's considered a high probability bet. So if you sell an out of the money call, you have a better than 50% chance of making money. However, the downside is
unlimited risk.
Unlimited risk. You could have a stock that could rip, 50% on you, and you are on the hook to buy that stock to cover your short position, and the risk is unlimited. Stock can go.
Yeah, and we're talking the minimum size for an options trade is 100 shares. So you could actually end up with a highly leveraged position going against you.
That's right.
We're going to talk about this United Healthcare trade, but first we got to break down what we're talking about. The covered call. This is where you sell a call option for 100 shares at a set price and an expiration date on a stock that you already own in an equivalent amount. So if I own 100 shares of United Health, I can match that with an option, and tell us how that covered call works.
So if I owned 100 shares of United Health or any stock, I could sell an out-of-the-money call against that position. That out-of-the-money call obligates me to sell 100 shares at the strike price. So with UNH trading around $300 last I looked, you could sell a 320 call, and if United Health doesn't get to 320 by expiration day, you keep that premium. And then you can do it again if you'd like. And this is a way that people who own stock like to enhance their yield or lower their cost basis in a long stock position.
And that works out really well if you happen to be down 40% in the stock, which is what it's lost this year. Coming up, we're wrapping today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell on Market Domination Overtime. Hello and welcome to Market Domination Overtime. Stocks close lower. Yahoo Finance's master of the Wi-Fi Interactive, Ines Ferre, is standing by with the latest. Ines, what are you watching to close 2025?
Jared, I'm watching those double-digit percentage gains in all three major averages for 2025, even though today we saw the major averages lower. But look, for the year, I'm pulling up the year-to-date chart so you can see the Dow up almost 13% year-to-date, the NASDAQ Composite up 20% year-to-date, and the S&P 500 up more than 16% year-to-date. Do want to mention the small caps also up more than 11%. If we take a look under the hood, it's the tech trade that was really powering the markets this year. Take a look at the technology stocks up 23%, communication services up 21%, industrials up 17% as well. And then looking at the NASDAQ 100, you can see the green on the Mag 7 stocks with Alphabet that has led the gains year to date, up 65% for 2025, and also Nvidia up nearly 39% for 2025. You've got Tesla that's up double-digit percentage gains, 11% for the year, and Microsoft as well. Also, the semiconductors, because we mentioned Nvidia, but these were really on fire this year as the AI trade has boomed the markets higher. And so you're looking at Broadcom up 50% for the year, AMD, Micron up 230% for 2025. We did see crypto this year in the red, down 7% for the year after it tumbled from all-time highs in October. And then looking at ETH, that down 11%. And over on commodities, we have seen a lot of action in the commodities space, with crude oil down for the year, down more than 21%. Brent crude down 20% for 2025. The ones that really had a stellar year were gold, up 62% for the year, and silver, despite the volatility that we saw this week, silver still up 137% for 2025, Jared.
Thank you, Ines. And stocks are slumping the final days of 2025, but overall it was a strong year for the market. And the S&P 500 is up over 15% for 2025. And my next guest says there's plenty of more room to run. Joining me now is Jay Hatfield, Infrastructure Capital Advisor, CEO and CIO. Jay, it's always great to see you. And we're going to get to some big market calls in a second, but you and I were just talking about some of the big themes for 2026. You say it's key to watch inflation over the next few months.
Absolutely. Thanks, Jared, and Happy New Year. Every investor should always be laser focused on inflation and the Fed. That drives all cycles, that drives the stock market. Absolutely critical. And the key driver there is the money supply is negative. We've never had inflation, significant inflation, when the money supply grew less than 5%. So inflation is going to go down. The good news is it's been mismeasured, but it's very likely to roll down very substantially after the first 2 months. We had very hot prints the first 2 months of last year, or this year.
And so just the comparison should make it a little better.
Absolutely, and shelter has normalized, so shelter is miscalculated in CPI. So the combination of those two factors, shelter going back to normal, it's hard to imagine in New York City where we are now, but the rest of the country, rent inflation is near zero. It's not reflected yet, but it is going to be reflected. And so you're going to get these really great inflation prints, and that's super bullish, and nobody seems to be very focused on it. But that is critical. We have an 8,000 target. That's really critical to maintain 23 times earnings. You need lower rates.
Let's talk about that 8,000 target. That would be the level of the S&P 500.
Right.
It's sitting at about 6,800 and change right now. It hit 6,900. I don't think it quite hit 7,000. But what do you see? So you see this S&P 500 at 8,000. But give me the mix. Give me the sector mix and where you see some of the hot spots.
And we did have 7,000 this year. And it's good to point out that targets are meant to be sold as well as bought. So like if we
I hope you sold it.
Yeah, you can fade it a little bit. And what I would say, why I brought that 7,000 up, is that the Mag 8, we include Broadcom, but the Mag 8, when we did hit 69.40, in our models was fully valued. Not like crazily bubble valued, but fully valued. So we think that the Mag 8, or tech in general, is going to do fine this year, but probably not outperform its risk. So in other words, NASDAQ has twice the risk of the S&P. So it's a good time to go look for bargains that nobody really cared about this year.
Which are, let's get to that.
Right, so we correctly predicted that investment banks would do well this year. Because we thought it was obvious, but it wasn't reflected in the market because of M&A, deregulation, IPOs, and also fixed income.
Just looking at Goldman up 55%.
Right, exactly. So that was one of our biggest positions in ICAP, and we recommended it publicly. But now, if you look at models, because we care about valuation, a lot of people don't, but we do, and I recommend everybody does. But it's pretty fully valued, not that it's going to do terribly, but why not rotate into cheaper financials? So they're risky, because you want to be up the risk curve if we're anywhere close to correct. So why not be in regional banks? They haven't really done much. We're going to get lower rates, according to our bullish view on rates. And bonds are rolling down, so all the cheap bond or low income bonds are starting to roll off. So you're going to upward sloping yield curve, more net interest margin, which is boring. It's not as exciting as investment banking fees, but so you're going to get better net interest margin. Those companies are way cheaper than the investment banks. And then we also, on a related note, like or love really the alternative asset managers. Everybody sold them off. Yeah, KKR, the big names, Apollo. They sold them off because of credit fears. We think they're totally irrational. They've been rallying a little bit off the lows, but we think there's a ton of upside there.
Where should investors be wary? Where should they steer? What should they steer clear of?
We don't see any like big pitfalls, but it's not the greatest year, in our opinion, to be super conservative. So you don't necessarily need to be in consumer staples or
another YOLO year for the meme crowd.
There's going to be cycle. We don't do that, but because it's Bitcoin seems wonderful at 125,000, but not so wonderful when it goes to 80. We like these things called earnings and cash flow, because then you can predict when something's overvalued, and when it gets cheaper, you can enter like. I actually think Bitcoin's making a bottom, but there's no numbers that actually support that, or no fundamentals.
Yeah.
So we like fundamentals and reasonably valued companies. So we don't do the meme stock trades.
Let's talk about tariffs. That was one of the defining terms of the year, and we saw that huge post-Liberation Day sell-off, which was a huge buy-the-dip opportunity. Where do you think tariffs fall this year? Do you think the Supreme Court, does it matter if the Supreme Court strikes them out? And do you think Trump comes back and tries to reinstatement, or just lays back and is like, okay, the Supreme Court did it, and that's the trade?
Well, ironically, I'd say this is our least popular opinion, is that we were pro-tariffs, but I would draw a distinction between regular tariffs, like sales taxes, like 10 to 20% tariffs, and trade wars. So trade wars are awful. You don't want that with China. So we're in favor of it, though, because it improves the budget deficit. We're forecasting 1.45 trillion, which is a huge drop in the budget deficit and now sustainable. So we're in favor of tariffs. What we think will happen, decent chance that SCOTUS overrules the president, because he probably did exceed his authority, but there's other laws that he can use, and we think they'll just reinstate those, probably without reimbursement. So it might create a little bit of market volatility, but we think it'd be way better. It's almost impossible to cut the budget deficit in the United States because taxes are unpopular, cutting spending is unpopular. Politicians shockingly like to get reelected.
Spending's fun. Jay, we got time for one more here. Under a minute. Anything we didn't get to that you want to talk about to investors?
No, I would just say that it's critical to stay invested. A lot of people in profitable companies. Okay. Because the companies will grow earnings as long as they're retaining earnings, investing in good projects. So if you want to gamble, do Bitcoin, do prediction markets, do meme stocks. If you want to make steady 10, 15% returns forever, buy profitable companies trading at reasonable multiples.
All right. Sage advice, Jay. Great to see you here. And it is time now for some of today's trending tickers. Starting with the metals trade, silver and gold retreating once again. The move lower comes as exchange operator CME Group once again hiked margins on precious metal futures. But looking at 2025, gold had a monster year. The yellow metal enjoyed its best year in 2 generations. The rally has been driven in part by rate cuts and tariff tensions. Meanwhile, the price of silver has more than doubled. And Strategy, the company best known as the world's largest corporate holder of Bitcoin, is trading lower as crypto is capping a year defined by record highs and a dramatic crash. Strategy recently bought up more Bitcoin after hitting the pause button. Bitcoin logging its third straight month of losses, a rare instance. However, there's been some talk that a bounce could be in the cards as early as next month. Lastly, Brookfield Corporation is reportedly looking to start its own cloud business. That's according to a report from The Information. Brookfield would lease chips inside data centers directly to artificial intelligence developers. The cloud business will be tied to a new $10 billion AI fund that the firm plans to begin. Coming up, we're going to take a look at the outlook for cryptocurrencies in 2026. Up next on Market Domination Overtime. Crypto markets are heading into 2026 looking a little bit different than past cycles. Activity is increasingly shaped by institutional trading and real-world use cases like stablecoin payments. The big question for investors now is whether crypto is finally maturing into a more durable market or entering a new phase of risk. For more, we're bringing in Andrew Forson, president of DeFi Technologies. Andrew, it's great to see you here. Talk to me about 2026 and the crypto outlook. We were just talking with a guest who likes the technical setup for Bitcoin, but talk to us about institutionalization. We just came off probably the most friendly year for crypto regulation ever, and Bitcoin was in the red. What changes in 2026?
Thanks so much for having me, and Happy New Year. I think you are going to see continued institutional adoption, and I would probably say the biggest thing that we're going to find in the digital asset space is that the technology is actually going to be deployed in more places, in more technologies, in more utilizations that people wouldn't otherwise notice. I think the killer app in the digital asset space, as you correctly noted, are the stable coins. But increasingly, we're seeing that institutions are actually moving other assets on chain, including stocks, bonds, commodities. And this will only increase utilization and therefore the underlying values of these digital assets.
So talk to us a little bit more about the stablecoin and why exactly that is so big for Bitcoin and also the institutionalization that we're talking about here.
Yeah. So what we're finding with stablecoins is every stablecoin actually exists on a distributed ledger, on a decentralized ledger. So every time we hear of discussion of a stablecoin, there are a number of underlying blockchains upon which that stablecoin resides in order to validate the transactions. Now, this is important because you will then be able to park your assets in an instrument like a Bitcoin or an Ether, or in the case of DeFi Technologies and Valor, in one of our exchange traded products, and then move it back into an on-chain instrument and back into the stablecoin space. So it means you have fluidity and fast resolution of assets going from the stablecoin space into yield generating assets and back into the fiat equivalent, which is the stablecoin. And all of these things are using the underlying digital ledgers and blockchains that form the basis of the cryptocurrency industry.
Any other use cases for DeFi that we haven't really seen? I mean, we saw the rise of NFTs 4 years ago. I don't know if they're going to make a comeback, but anything that would really excite the public again that you see coming?
Yeah, I think there are a lot of very interesting use cases. For one, you are looking at a rise of artificial intelligence. But what we also know is that provenance for some data sources has to be proven. And a great way of proving the provenance of data to be used to train an AI model is by actually logging this information onto the blockchain. I think the second killer app or killer utilization use case for digital assets comes with the movement of actual traditional assets into the DeFi space, particularly the ability to settle assets, equities, bonds, trade globally, quickly, and bring additional liquidity into that space. All of these things are made more possible, more flexible by leveraging distributed ledgers in the blockchain space. And that's very, very important. That's an area where our own company, DeFi Technologies, is looking to focus in the coming years.
And talk to us about prediction markets, because some of those are built on the blockchain as well. And we've just seen a tremendous interest in not only prediction markets, but some of the other levered products that are entering the traditional capital markets with leverage ETFs. But strictly speaking, with prediction markets here, how do you see that shaping up in 2026?
Yeah, you raise two excellent points. Prediction markets, I think, are going to continue to grow. Because they offer a range of solutions that give regular people and investors the ability to access value. But it also, the prediction markets are actually structured in such a way that derivative instruments could be made off of them, and the actual predictive processes can be tokenized they themselves. And it is interesting, the point that you make about levered products. We actually launched two of our bull two-time levered products under Velour ETPs this month. We are going to find, now that digital assets have become more broadly accepted, there'll be more interesting structured instruments that could be made to fit a broader range of investor profiles. So I think both prediction markets and more interesting targeted structured instruments will be things that you will start to see, and people will be finding that they're going to be including these things into their regular portfolios to be able to create targeted return profiles.
Anything we didn't get to here, big predictions for 2026?
I think the biggest prediction for 2026 will be seeing that regular people, regular corporations that are not necessarily crypto native, are going to have an easier means of accessing these instruments. It won't be a particularly interesting or unique thing to be able to invest in these assets. It will become an expectation. And then the other thing is that the on-rails and on-ramps for accessing these digital assets will become merged with traditional assets.
All right. Thank you. Thank you all for all that, Andrew.
Thank you so much.
Have a happy New Year. And 2025 was a record-breaking year in the markets, and the hot AI trade brought some changes to the rankings of the world's wealthiest people. While the rankings may have shifted, the names haven't changed much. Elon Musk is keeping his title as the world's wealthiest person. According to the Bloomberg Billionaire Index, his net worth now tops $623 billion. Most of that gain driven by the skyrocketing valuation of SpaceX, which is now at $800 billion. Musk owns more than 40% of that company, so when its value rises, so does Elon's net worth. Tesla's 12% gain this year also helping to lift his wealth. And just under Musk, we start seeing some of the changes in the rankings. Jeff Bezos started out the year in the number 2 spot, but he drifted down to number 3. He's sandwiched by the founders of Google, Larry Page and Sergey Brin. Page is in the number 2 spot for 2025 with a net worth of $270 billion. The Google co-founder vaulting above Bezos as shares of Alphabet soared more than 60% on optimism over its AI business. Page's rank jumped from 7th in 2024. And his co-founder Sergey Brin rose 6 spots from last year and finished 2025 as the 4th wealthiest person with a net worth of $251 billion. Page and Brin collectively own about 6% of Google shares. Back to Bezos. His net worth at the end of 2025 sits at $255 billion. His wealth is built on his Amazon stake. He owns just over 8% of the company's stock, which rose less than 6% this year, underperforming the broader market. And rounding out the top 5, we've got Oracle founder Larry Ellison. His net worth has been on a wild ride, swinging big with Oracle's stock in 2025. Ellison still owns 40% of the company. Just a few months ago, Ellison was the world's 2nd richest person, but after Oracle's 40% slide from its September peak, his ranking fell to 5th. He's also tying his wealth to a possible takeover of Warner Brothers Discovery, as he has guaranteed his son's bid for the media giant to the tune of more than $40 billion. Some of the other names you know in the top 10, Mark Zuckerberg, Steve Ballmer, Jensen Huang, and Warren Buffett. And that's going to do it for today's Market Domination Overtime. We're off tomorrow for the holiday, but be sure to come back Friday at 3:30 p.m. Eastern for all of your coverage leading up to and after the closing bell. Good night and Happy New Year.